All right, been focused on shares of Warner Brothers Discovery for some time. It's been a sad story if you own the stock, of course, really ever since the split from AT&T. You can take a look. That's not instructive of recent. That shows the response to after earnings. Now, yesterday the stock was down, in part because suddenly maybe people were taking a look at the other side of the balance sheet. Obviously, a lot of debt there. Now it's down to $50 billion. They did reduce the debt. And, you know, their CFO would tell you, listen, we have very limited maturities coming up over the next couple of years. They run scenarios. He said, even in the most dire scenarios, no requirement for us to come back to the debt markets to refinance anything. But yesterday, my reporting on Altice, perhaps some people starting to, get a little concerned. As for the numbers, going through all of them right there. Right? They increased their synergy target to $3.5 billion from $3 billion. They added 2.8 million direct-to-consumer subs. And they moved up the launch date as well. Thank you for their combination of HBO Max and Discovery Plus. That's going to be in the spring now, so it's coming soon. Pricing may go up, they indicated on the call as well. As for the quarter, ad revenue was the big headwind. We've seen it in a lot of other places. They continue to talk about it in the sense of, hey, you know what? It was down 11%. We're going to do about $9.2 billion in adjusted EBITDA this year, and we still see $12 billion next year, but the reality is, and this is again quoting the CFO, the scatter market has been pretty dry right now. It is what it is. As we know from experience, these periods pass, but it's not a very constructive environment right now. And as you heard from a number of other players and peers across the broader advertising market over the last few weeks. So that's in question. They're taking down debt. Their cash flow is impacted by a lot of other write-downs and things of that nature. They still see $3 billion in free cash flow for the full year, and they are reducing costs, Jim. And then I got some things we'll talk about on direct-to-consumer that were interesting.
Call versus what you just said, how the NBA on TNT is moving things, still being terrific. That the sports are great, the movies are really good. All of that was excellent. And David, I come back. Altice, you mentioned yesterday, 6 times net leverage.
That was Altice.
Altice. Here's
they're 5 times.
Now, let me ask you something.
6.2 times on Altice.
When you study business, 3 times is about as ugly as you want to get.
Depends on the business and the cash flow characteristics of the business. Right here, they're talking about...
What was the free cash flow this quarter?
It wasn't good.
What was it?
It was negative,
Negative $192 million.
But that involved a lot of...
I know. This one time they paid the bonds, whatever.
They had to pay the bond. They had a lot of different things. They're still looking at $3 billion in free cash flow for the year.
But I do still feel. That there's a lot of risk. That's my term for it.
The other reason I follow this, I find it fascinating. I have for 25 years now this transition to now what is, of course, direct to consumer. Whether or not the business it's replacing, which is the linear cable business, which declined, by the way. Revenues were down overall. Now we're 8% here because fewer people are simply connected.
But you didn't think
But whether the characteristics of this new business that we've now been following for years as a result of Netflix are going to in any way look like the old business in terms of profitability still remains a key question. The Netflix multiple has come and gone, and a lot of these business models that came since saying we got to be about direct-to-consumer were built on the idea that, hey, Netflix has got this incredible multiple back in the day, which it doesn't have anymore. And here's what Zaslav had to say about, overall sort of the idea of getting subscribers at any cost.
I believe the grand experiment, chasing subs at any cost, is over. Let's face it. The strategy to collapse all windows, starve linear and theatrical, and spend money with abandon while making a fraction in return, all in the service of growing sub numbers, has ultimately proven, in our view, to be deeply flawed.
He went on to say, guys, that the movies we launched in the theater do significantly better, and launching a 2-hour or an hour and 40-minute movie direct to streaming has done almost nothing for HBO Max in terms of viewership, retention, or love of the service. Interesting.
Yeah. Look at AMC today, where subs were up 44 and revenue's still down 16. Now, some of that's currency, but some of it does reflect the softer ad macro.
Look, there's problems all over the place, but I got to ask David directly. the direct-to-consumer subs at Warner Brothers, 94.9 plus
Yes.
2.8 million additions. Is that really bad?
Is that bad?
Yeah.
No, it's right around what people were expecting. I mean, they're closing in on 100 million subs.
I'm giving Zaslav some due here.
Paramount's at 67 million. They came in light.
Right.
Peacock's only 15 million paid subs. Obviously, if you're a Comcast cable subscriber, you get it. The question remains, all the money being spent on this content to keep and bring in new subscribers, is it in any way going to generate real returns?
Well, but there's Zaslav, who's a figure of great prominence in our industry, talking about, you know what? The age of content is back.
But he's also talking about the fact that you got to do it in movie theaters. You got to even consider still licensing it, selling it to third parties, and you've got to use it to actually keep your own streaming service robust. He's not saying that you just got to keep feeding the beast endlessly and spending enormous amounts of money. We'll see how this all plays out. And when you have $50 billion in debt, you better not make too many missteps.